Welcome to Fun with Annuities, where every single week I welcome a celebrity guest expert that can help you maximize Chapter 2 of your life. Listen, learn, laugh, and love every minute of the most unique financial podcast on the planet. Let's get to it. Welcome to Fun with Annuities. I'm your host, Stan, the Annuity Man. Proud and privileged to have a repeat guest on our show. When you look up the words consumer advocate in the dictionary, her picture should be there because she was actually a financial consumer advocate before anyone started talking about that. Her name is Terry Savage. Welcome, Terry.
Thank you, Stan. Always good to be with you.
Let's jump in. Let's skip the formalities. We're good friends, and I'm dying to hear what you have to say. At the time of this taping, we're not in Jackson Hole, Wyoming, but we have been watching Jackson Hole, Wyoming, and the Fed. Weigh in on all this chaos, Ms. Savage.
Well, finally, at last, and it doesn't matter what you say or what I say, the stock market had its say today, up over 450 points to a new all-time high. And just think, everybody thought this was in the market. What happened today, which by the time you listen to this podcast, you'll probably have heard, is that the Fed chairman finally acknowledged that it was time to start cutting rates. The time has come, to quote him. Right. And but even more so than that, he took a victory lap. And I think in my latest column, which I just posted at terrysavage.com, and it'll be syndicated in your local newspaper in the week ahead. Mm-hmm. He took a victory lap, a well-deserved victory lap, because forever and ever, in order to get inflation cured, think back to 1980, 82, 83, which was the most dramatic example, the Fed had to jack up rates and then create a humongous recession and throw a lot of people out of work to cool the demand that was pushing rates up. This Fed board and this Fed chairman seem to have managed to cool inflation. It's not down to their 2% desired level yet, but it's getting there. And they have done it without, well, as the Fed chairman said, yes, and unemployment is up about 1%, but it's at 4.3%, which is still a very low rate. So they haven't thrown a lot of people out of work. He explained that part of this was more people coming into the labor force that's helped them out. So they've done a cooling of the economy, a slowing of inflation expectations. Mm-hmm. They did not create a recession. Take a bow, Fed chairman, for a soft landing, and they're about ready to cut.
Hard question. The 800,000 job redo that just was announced that one of the cabinet members didn't even know existed, which is kind of crazy. But when they had to readjust that 800,000, I keep saying dollar, I guess it's because I'm in the dollar business.
It's money.
800,000 job readjustment. What was your take on that? And for the people that don't know what I'm talking about, the government had to readjust the jobs number by $800,000. Again, $800,000, Terry.
Fucking real money.
I know, but give me your take on this 800,000 number, because when I saw that, the conspiracy theorist in my head was like, "Wait a minute, that seems interesting timing."
No. Numbers are always restated, and I posted a column at terrysavage.com. I want to point out how apolitical the Fed is. I don't think the government is really the one that the Labor Department, which does the jobs numbers, I don't think that was intentional. There would be too many heads would roll. But I want to give you this little piece of research. The Fed always says it's not political. The Fed always adjusts interest rates despite an upcoming election. And there's a JP Morgan Chase article, asset management article that I linked to. And it says, since 1980, the Fed has either hiked or cut rates in every single election year, except in 2012. And by the way, if you don't remember, back then rates were at zero, and right. The economy was, coming out of the financial crisis. Otherwise, the Fed cut rates in 5 election years and hiked in 5 election years. And in some years, there were more than others. For instance, in 1980, they actually hiked once by 1% and cut rates by 5.5% between February and July. That was that recession we were talking about. So I think that we can count on the fact that no matter what the politicians say, because there is obviously going to be a rate cut coming, that the Fed is apolitical. History says they're apolitical. They rely on the numbers. We'll get another jobs number, as you point out, in the next week. We'll have another consumer price index number before they announce that they have their next meeting. But it's pretty clear that there will be a rate cut. It is not political. And, the Fed's gotten a lot of bashing and a lot of, threats of controlling it and replacing the Fed chairman and so forth. But I think if we manage to slide through the end of the year with inflation still staying down at this level, without a recession, and there, the leading indicators are a bunch of signs that the economy is slowing, maybe even too much. We'll see. But I think this Fed has done just a terrific job.
Interesting. And you've known Fed chairman and chair. I mean, you chair people.
Let me tell you how far back.
Yeah, go back. Tell people your credentials. Throw down the credentials here.
Okay. But let's back up. I was a founding member and the first woman trader on the Chicago Board Options Exchange. That's a long, long time ago. And at the time, the local TV station in Chicago was looking for someone to explain inflation and interest rates. I feel like I came through this movie before, and I still have a videotape of me walking alongside Paul Volcker, who is incredibly tall.
Paul Volcker, he was like 6'8".
Yes, he was. And I remember him saying to me, "You really know these numbers, don't you?" We were talking about the money supply in those days.
Right.
That's when people first came to understand the linkage between the creation of money and inflation expectations. So I've been around this game for a while, and I've seen Fed chairman. I remember Milton Friedman saying, "I see no recession on the horizon." He was wrong. I remember Ben Bernanke and helicopter money and so forth.
Yeah.
I happen to think that Jay Powell, I'll give you a Jay Powell story. Back in about 2012, I just mentioned that interest rates were almost at zero. Do you remember that in Europe, rates were actually negative on euros, and the people were paying the banks to hold their money? There was so much concern.
I remember.
Huge amount of negative interest rates on bonds in Europe, in the Eurozone. So I was at a dinner where it was a business dinner, but questions were allowed. And as a journalist, I've written a syndicated column now for 35 years. And you can read my columns at terrysavage.com. I raised my hand right away. Jay Powell was maybe 10 feet in front of me. And I said, because T-bill rates were like less than a quarter of 1% in the trading markets. And I said, "Excuse me, Chairman Powell, but do you foresee Treasury bill rates going negative in the United States the way rates have gone negative in Europe?" I will never forget this. He fixated me with the most stern grin, and his eyebrows drew together. And he said, "We will not have negative interest rates in the United States." The way he said it was literally chilling to me, like he alone. And I think he did. And we didn't have negative rates.
Well, because I can't say the word jobs and I keep saying the word dollars instead of jobs. We're in a political environment. I always tell people red or blue, it's all green to me. I don't really care either way. We're going to survive as a country. We just have to plan, and we have to make those plans regardless of who's going to be in office. In your recent article, you always mention chicken money, and chicken money for Terry Savage, which hopefully she's trademarked. If not, I'll trademark it for her on her behalf. It's the money you don't want to lose. It's that principal protection money. And what you mentioned in there was chicken money, even with rates, decreasing, is still not a bad play. Can you cover that?
Yeah, well, this all came about many years ago when I was giving a speech, and I said the world's really divided into the bulls and the bears. Bulls think the market's going up, the bears think it's going down. We're much more savvy now than we were when I was speaking to audiences back then. But I said, I add a third category, the bulls, the bears, and the chickens. And there's nothing wrong with having chicken money. And in fact, you should have some, and how much depends on your situation, not just how old you are, but how much money you have, what your financial needs are, and what your own personal risk tolerance is. What lets you sleep at night? So you sort it out. But chicken money by definition is money you cannot afford to lose. And as such, it belongs in things like short-term CDs, treasury bills. There's a column up at
AAA munis, MYGAs,
how to buy
CDs.
treasury bills
Yeah.
direct from the Federal Reserve, not through your broker, through Treasury Direct. The very, very safest things that let you sleep at night. It's as the mantra of the chicken money investor is, I'm not concerned about the return on my money as I am about the return of my money. So that's how you sort it out.
Absolutely correct. No.
Okay.
And I love chicken money. I love it.
Yeah. Well, so here's what's happening. About maybe 2.5, 3 years ago, I started talking again, as I had in the 80s, about treasury bills, because the banks were very slow 3 years ago to lift their rates on CDs.
Right.
Now, treasury bills, let me just do a one-on-one. You have a sophisticated audience, but just in case. We have a national debt, $34 trillion national debt. Don't get me going there. We borrow money. And every Monday, we have a treasury auction of 3- and 6-month IOUs, treasury bills, billions of dollars as old maturing ones come due, and we borrow more money. The rate at that Monday auction midday is set by huge institutions around the world, central banks, huge institutions bidding. They decide what the rate they would accept based on the outlook for inflation, what's going on in the US economy and the rest of the world. And when you buy T-bills, you agree to accept that average rate set at auction. Well, about 4, 5, 6 months ago, the 6-month T-bill yield, which you buy at treasurydirect.gov, minimum $100. This is not for just rich people.
Right.
That rate was about 5.5%, even a little bit higher. Now, as we speak, that rate is down under 5%. And because the Fed is obviously about to cut rates, you will see, and those people who bought them T-bills, themselves T-bills 4 and 5 months ago and said, oh, automatically renew at whatever the auction rate is, that auction yield will be lower in the coming months. And the money that drops down into your account in the form of interest from your T-bills will be smaller. Good point, though. Even if the T-bill rate for 6 months is like 4.8, maybe 4 3/4, we've still got inflation down near 3%. So you're still making a pretty good deal for yourself. However, it will be less dollars in interest earned, less dollars the government will have to pay, and that will add to the national debt. But the fact is, T-bills, you buy them, you roll them over automatically at maturity, and that's where your chicken money goes. But those rates are coming down, and savers will have to be prepared. But still not a bad deal when you consider inflation is lower.
And I look at chicken money, really, I think there's 5 products. There's CDs, there's treasuries, there's money markets, there's AAA municipal bonds, and then there's multi-year guarantee annuities, which is the annuity industry version of the CD. All of those are principal protected. Anything outside of that category, you got to convince me why. And of course, all of these come with different types of maturities and different types of rules, but I do think everyone needs chicken money. I do want to pivot, however, to the beloved stock market.
No, wait, before you do that. Wait, before you do that. Folks, by the way, any of you haven't watched me on a podcast with Stan, because I always take what I learned from him and I do every time. And I want to educate my readers who are maybe not as, in daily newspapers around the country. Stan, multi-year guaranteed annuities. I've never, to be quite honest, included those in my chicken money.
You got
They are insurance company contracts.
Correct.
Okay. You know that all the banks are short. If you get a 1-year CD, it's FDIC insured. It's the same insurance whether you buy from your local state bank or a big, well-known national bank. Okay. I never included MIGAs, and we were going to have a little discussion here in my chicken money because, number one, they're insurance company guarantees, which if an insurance company went under, that's only insured by a state guarantee fund, which does not exist. We've talked about that before. So I'm going to ask you, explain why you think, first explain a MYGA, and then why you think that should fit in chicken money. Because the other aspect of chicken money is you get access to your money pretty quickly in a money market deposit account, money market mutual fund, T-bills. You're 3 or 6 months out, you can get your money. So why do MYGAs fit in that category?
They have to fit in that category because, number one, they're principal protection products. Number two, they function just like CDs. The difference is that, and they can be held in all types of accounts, but the difference is in a non-qualified, non-IRA account, that interest can grow tax deferred. With most MIGAs, there's liquidity features. You can take out the interest, or you can take out 5% or 10%. They're all different. If you go to my site at theannuityman.com, we have a live feed for your specific state. But the backing of the companies, life insurance companies issue annuities. They issue these fixed annuities. And there are rules in place for these life insurance companies to not be as dumb as banks. They're not smarter than banks. They're just more regulated than banks. And they have to have your money on hand 100% in investment grade bonds day one. And most of the time that we have seen a company be absorbed by the state guarantee fund, it's only happened a few times since 2008. What typically happens in the annuity world is another life insurance company will come in and buy that company up and the guarantees that they have outstanding, because annuity products, even MIGAs, are what I call golden goose products. You cannot lose confidence in them, and the big companies know that. But there are companies, the AAA, A double plus companies that issue MIGAs, that if they go out of business, there's anarchy and there's no power, and we're fighting each other.
We are at that point where I hope we never have to know the difference
Right.
of these big companies. I mean, that would be a crisis. Now tell me, I'm going to turn the tables because I get to interview Stan everyone.
Absolutely.
So if I said to you, okay, Terry just told me that today, probably next Monday's auction, the 6-month T-bill will yield 4.9%. The interest gets paid up front, but I don't declare it on my tax return to the year of maturity. I don't pay any state income taxes. That might be a consideration. So call it 4.9%. And then I know I'll have to renew in 6 months and the rate might be lower. So give me give me a product. Tell me from a double A.
Let me give you a rule.
On a double A company, what's the product you would sell me instead of a T?
I'm not going to specifically name a company or a rate. What I'm going to tell you is the rules that you have to have in place to choose. I always tell people, if your target date for maturity is less than 3 years, so that includes 3 months, 6 months, up to 2.5 years, never buy a MIGA. But if you want to lock in a guarantee past the 3-year time period, what you're going to find is the MIGA is going to be more competitive and have a higher contractual guaranteed yield than a CD. And the question, okay, Stan, why? And the reason is life insurance companies have many factors that they price off of. Life insurance, that's very profitable because they know when you're going to die. Lifetime income products, that's very profitable because they know when you're going to die. Legacy bond portfolios that they've had in place forever. And then capacity, what they can bring in and guarantee. And typically multi-year guarantee annuity companies, because people say, well, wait a minute, Stan, why would this MIGA be higher than a CD, the 4-year MIGA higher than a 4-year CD? It's because the annuity company, the life insurance company that issues the annuity, and this is a kind of a broad rule, if they can make 50 basis points off the money, they'll give you, let's just say they'll give you 4% if they know they can make 3.5 on short-term paper and all the other things involved in pricing. That's the reason the 3-year and out rule is what I tell my clients to look at. Obviously, we look at claims paying ability of the carrier, but we really haven't seen a lot of disruption in the MIGA space. One more thing, Terry, that I want people to understand. If people are out there and they think that taxes are really going to go up and they don't want to pay taxes on their interest, the good part about a MIGA and a non-IRA account, and yes, you can have them in an IRA account or Roth, but let's just talk about non-qualified money. If you don't want to pay taxes on that interest, you can let it defer. Or you could just
take it out.
Yeah, or you could take it out when you need it. In other words, look at a MIGA interest like a light switch. Okay, you can flip it on and off when you want, but let's just give you an example. Let's just say they go, okay, all you evil rich people with MIGAs out there, we're going to tax that interest rate at 90%. I'm just bringing that as an example. Then don't take it. Okay?
All right, wait, let me stop you. With people wondering what I was doing, this is my phone. And here's what you can do. I went on cnbc.com and in the top is the markets, and I looked at bonds, and I do this all the time. And right now you talked about, okay, not less than 3 years. I wanted to make that very clear. Chicken Money has short-term, very short-term access, but not a MIGA because there probably are penalties and so forth. But now let's compare apples to apples. I'm looking as we speak At the 5-year U.S. Treasury rate, it trades in the multi-trillion-dollar Treasury market all day long. And then at 1 month, there'll be a 2-year note auction or a 7-year or 5-year, whatever. So as we talk, a 5-year note, a 5-year Treasury, U.S. Treasury, is yielding 3.64%.
On a 5-year.
On a 5-year, that's. I mean, I'm looking at the real
And that's
market.
great.
So if I called you up today and said, Stan, and again, this will be different when you hear this, but I'm talking about today is the day that Jay Powell said, yeah, we're going to cut rates. So actually rates are down. The yields are down a little bit. They were close to 3.7% yesterday at this time, but today it's 3.64. So if I call you up today and say, you're going to give me like a CD thing where I don't have to pay taxes until I take it out at the end, and I could keep rolling it over. And you're going to give me a guaranteed rate, guaranteed by a AA plus insurance company. So I'm not waking up in the middle of the night. I'm pretty well locked in for 5 years, but I would be more or less in a Treasury. What's the yield I could get on my MYGA?
I'm not going to give a specific year but let's just say it's 100 to 150 basis points higher typically. Okay.
You said today you could get me 4.5%.
Yeah, you could. But here's the thing.
Okay, now
but it's not as static as that, Terry. Don't make it that static. If someone calls us and say, I'm deciding between a Treasury and a MYGA, then I'm going to say, how big is the safety factor to you? And if they say that's all it is, and I'm going to say buy the Treasury. Because it's the safest money on the planet. Period.
Is it 75 basis points or 100 basis points safer than the MYGA from the insurance company for the same 5 years?
It depends on the person. You can't just say you always buy the MYGA because it's higher. It's going to be higher, but you're going to have to feel comfortable with the claims paying ability of that carrier and state guarantee funds, however you want to frame that. But I want the MYGA, and we put this in our chicken money. It's just part of the 5 chicken money categories. Again, CDs, money markets, Treasuries, munis, MYGAs.
Okay. You've done what I wanted to do. I think I'll write another column about MYGAs because all of a sudden the rate gap is very interesting.
Yeah.
But here's what I'm saying to all of you. If you buy a 6-month Treasury bill, by the way, you have to wait from Treasury Direct. You have to wait until it matures. You want maturities instantaneous because your kid's going to college, or you might need to buy a new car in 3 weeks. Then you put it in a money market fund. You can buy a Treasury only money market fund. That's instant access. Treasury bill, get 3 and 6 month access, decide your maturities, stagger them. On MYGA, you've got a 5-year.
MYGA has instant access too with a lot of them.
Well, there were some allow loans, right? But you're going to get a higher rate there. But again, the chicken money definition, I'm not so concerned about the return on my money as the return of my money. I have no hesitation, Stan, in having my chicken money in T-bills, but for also what I call chicken money about principal risk, I have no hesitation about putting a portion of that in a MYGA, but that's a longer term commitment, a little bit less liquid, and a teeny little bit, please God, we never have to differentiate between the safety of the Treasury printing all the money it needs and insurance.
There's no difference. Listen, if the Treasury is the gold standard of safety, all the conspiracy theory people can email me, but I'm telling you, that's as good as it gets. And then underneath that, you can argue it's FDIC or SIPC, and underneath that, you can say AAA insured municipal bonds. If you want to argue that, I would say out of all of those, and we're talking about Treasuries, CDs, money markets, AAA munis, and then MYGAs, I would put MYGA as number 5 ranked from a safety standpoint within the chicken money, but it has to be in the chicken money because it protects your principal. And there's the demographic tidal wave of people that are looking to say that what I always tell people, if you won the game, why are you still playing? That have enough money that just want to peel off the interest when needed, then do the chicken money strategy.
Another key thing, let's talk about, by the way, I know your listeners, I know all of you out there. I hear from you. My email is terry@terrysavage.com. So
and she responds. Okay. She gets a bunch of.
And I have an Ask Terry blog at terrysavage.com, and I stay up late answering those questions. I respect the fact that the audience for this podcast is pretty sophisticated, but you just made an important point I want to go back to. There are some people who have chicken money because they're older, they're retired, They're not working anymore. And this is all they've got. And they're
This is
just
it.
hoping to make their money last as long as they do. I'll
Mhm.
talk to you about the stock market and it's over the
Mhm.
long run. And I'm a
Sure.
true believer. I have been for all these years since my early trading days on the floor of the CBOE. But for some people, the chicken money is, if you don't have this, it's you shorten your lifespan by having a heart attack because you just do not want to lose it. And a lot of people are exposed to stock market risk in their retirement that they don't even understand. We can talk about target
That
date
is
funds and
correct.
all these con games that people don't understand the true risk. So, but your audience, you're right, is special. So when I talk to chicken money, I'm trying to reassure people who just want to keep it safe. It's all they have. They may be younger. A woman just got divorced. She got this much money.
That's right.
Yeah, over the long run, she should be invested in an IRA or something. But right now, she cannot lose that $27,500 that goes in a money market account. Now, all of you people out there have different choices to make. I think your audience is people who, A, pretty darn sure at this stage that they have enough or will have enough to be able to retire and continue to live comfortably. Many are concerned with, I'm just going to pass, what am I going to pass on to my children or
Right.
grandchildren? And that category of safety becomes a little bit different, a little teeny bit more risk that you could take in terms of earning more because this is not your last penny. So let's sort out chicken money for the chickens that are really pecking away at the last few grains there, and they have to keep it safer and shorter.
Well, and I think chicken money dovetails into the other thing that I preach about is income floor. You have to have an income floor in place so that you don't disrupt your investments. I think the 4% rule is dead. I think it doesn't hold water from a factual standpoint. Wade Fowle has destroyed it factually in
Yeah.
books, which is, and the 4% rule for people that don't know this, put all your money in the market and just take out 4% in gains when you need it. Well, that's fantastic in a raging bull market. If you have a couple of bad years, it's tough. I always tell people, you already own the best annuity on the planet, Social Security. Build from that with guarantees, whether it's a lifetime income annuity or the chicken money where you protect your principal and just take interest so that you can hit those annual or those monthly bills without disrupting any type of growth investments if you choose to do growth investments. But I think going forward into where we're headed, regardless of who wins the election, doesn't matter.
It really doesn't.
It doesn't matter. I know people are yelling at me, but
Yeah.
just bear with me. You have to plan for either party winning. You have to plan for it. And the interesting part about that, I need you to weigh in on this, is regardless of who wins, they're all going to be dealing with the same financial mess, and they're all going to have to do things that you can plan around. Whether they do this, then you plan for this. But I think now is the time not to watch the bad ads and the debate and all this stuff and the pundits on TV. The time is now to plan. Okay, if this person wins, this is probably going to happen. I'm going to plan for that. If this person wins, this is probably going to happen. I need to plan for that, which dovetails into the stock market. And I am absolutely dying to hear your thoughts on this rolling train down the track that we're seeing.
Well, this is very interesting what's going on now. I also put in a recent column some stock market history. We look at a lot of indicators that work for a while and don't work for a while, and a 67% track record is, putting some odds on your side. Here's one, a stock market indicator that has an 87% success record over the last nearly 100 years. And that is, if the stock market gains in the 3 months preceding a presidential election, which is to say August, September, and October, if the stock market is higher, let's leave it at that, a simple thing like that, 87% of the time, the incumbent party stays in power.
Interesting.
So, we've had some interesting days. We had that 1,000-point down day. We've had the stock market rallying. There's a reason I started our discussion today with the Fed being apolitical, because they do move during election years, and half the time they move up and half the time they move down, and it's not political. Okay, conspiracy theorists, you can have your say, but that's just, JP Morgan Asset Management. You can find that at terrysavage.com. Scroll down under my columns, and about the fourth one down now is the Fed political. So you can read it for yourself. So the fact is that we're having the stock market tell us some very interesting things these days. And we have to see. Now, I'm gonna disagree. I'm gonna say something that's controversial. I tend to avoid politics
Okay.
in my discussion, but particularly now, when you said it doesn't matter who wins in the sense of the markets and the economy, I agree with you more this time around than ever. I think this election, despite labels of left and right, and we're going to cut taxes for the rich or the middle class, I think this is going to be a really pivotal election based on a whole lot of other things that are very important to many Americans.
Sure.
And I think that economic policy, I go way back to when James Carville was in Clinton, it's the economy, stupid. Well, the economy's doing reasonably well. I mean, we're growing. We haven't had a recession. GDP is growing at 2% at least.
For a lot of people, it's not.
I understand that completely. But the fact of the matter is, I don't think the economy per se is the issue this election. Now, what you were right, whenever we get to the end of this, next February 1st, when we're okay, it's done, and let's go forward, we have some big issues. And we will have a new Congress.
Yep.
And those elections are just, I think, equally important. Not equally, but very, very important this year, because there will be big things to deal with. Now, you know that my co-author, have you had Larry Kotlikoff on your podcast?
Oh, absolutely. He's been on he's been on the podcast, and for people that don't know, he ran for president. Smart guy.
He's so smart. He's going to win a Nobel Prize. He wrote the book Stories from Social Security, and he and I wrote a book last year called Social Security Horror Stories about the $21 billion in clawbacks, because Social Security is such an accounting mess that they paid people that they now think they shouldn't have. There's no statute of limitations. We are meeting with the Social Security Commissioner. We have it on the books. He has, we were on 60 Minutes, and he referred to our book into 60 Minutes. He's limited clawbacks to 10%, but a lot of disabled people are just getting taken off the rolls and getting multi-$1,000 bills. Way back during the pandemic, you worked an extra 3 months and made more than the limit. So we want all the money back. We pay. You're still disabled, but you were over the limit for 3 months. Yeah. Give it all back. We are working to get that changed.
Yeah, Larry Kotlikoff, just like it sounds. Yeah. Type it in. I've done a podcast with him, and you can find his stuff with Terry as well. Like she said, she's been on 60 Minutes with him. Just a really interesting, smart guy with a big heart that's applying his brain to the betterment of society, just like Terry's been doing for the past 40 plus years. But yeah, very interesting person that is not accepting the Social Security answers at face.
Yeah.
He's solving them.
He's got software, by the way, Maximize My Social Security.
Absolutely. It's great.
Before you go claim or decide, should my husband do this? Should I claim on my spouse's benefit and then switch? Age 70 or 67, or I take it early. Go to MaximizeMySocialSecurity.com, pay $50. They will give you the correct answer, because 9 times out of 10, Social Security will give you the wrong answer, mislead you, and cost you a lifetime of benefits.
And your advisor doesn't know. Don't ask your advisor Social Security claiming question. If you ask me a Social Security claiming question, I'd be like, you got to be kidding me. I'd rather you ask me how a rainbow's made. No, you.
How do we get here? Oh, I know how we got here. We got here because I was about to say, Social Security is a big thing for me now. We have a website, Social Security Horror Stories. We have the book and everything. We are actively working every day to get the mess that it is. And the new commissioner, I must say, Commissioner Martin O'Malley, is doing a great job of trying to whip these people into shape. But you have thousands of agents, depending on who you get on the phone, capable of granting waivers on these clawbacks. They have no adult supervision. Don't get me started. But the point is, that's a current problem that Larry and I are making a dent in. That makes me feel good.
Good.
But the real problem is that Social Security is a really significant part of the income of millions of Americans.
The vast majority of people. The vast majority.
Because more than half of the people who get Social Security rely on it for at least 2/3 of their retirement income. So this is truly the net. And we know, this is not a political question. We know the actuaries say that we're getting within 10 years of the moment where the money coming in from the people working won't be enough to pay the benefits we've promised. Okay, so how do they deal with that? You can't reduce Social Security checks for someone's grandma who doesn't have anything. So this next Congress will have the last best chance to deal with Social Security. And nobody's talking about that.
Nobody's talking about any entitlements.
We're going to do this. But Social Security is just it's a number. Larry's the expert on it. He says that it's 75 trillion and they don't calculate beyond a few years.
Correct.
The fact is, the next Congress, both Republicans and Democrats, are going to have to deal with it. And what are they going to have to deal with? Raising the cap. Okay. Why should people who earn more not pay the tax? I know that's you. That's Larry. That's your audience. I mean,
yeah.
But the fact is, we talked about what would happen if the insurance companies collapsed or something like that. Social Security is just about as unthinkable as that. Correct. So either they print the money, and what's that called? Inflation. There you are, Zimbabwe, with whatever 892% inflation. You just can't print money. They have to come up with actuarial ways of dealing with Social Security, and we are on the cusp of that. So when you say to me, to everybody, and you're right, don't listen to the pundits and the economics and the platforms. That's baloney. They're going to have to come face to face with a bunch of financial crises. Right. Growth will solve the problem of the deficit. Political action or compromise of some sort will solve the problem of Social Security, or at least push it off. And the next Congress is not going to have the luxury of, not to mention all the many other issues that we face as Americans. The next Congress is not going to have the luxury of debating what's going on in the political world today, in my mind.
And I want to tell people out there, my clients, non-clients, people that tune in because they saw Terry Savage's name, solve for your problem. Okay. Everyone's problem is unique. You know, the financial pundits talk about, things from a 30,000 foot view. That's not you. Everything is customizable to your situation, period. And I've been on the other side of the desk. I work with Morgan Stanley, UBS. I work for them. I worked for Dean Witter and Payne Weber back in the day. So I've been on that side of the desk. Annuities don't solve for everything. They only solve for 4 things: principal protection, income for life, legacy, and long-term care. Never, ever, ever buy an annuity for market growth, regardless of that really good steak you ate at the seminar. But because it's not designed for that, and you never should buy it for that. Terry, do you think the artificial intelligence and that wave of technology that had a little bit of a hiccup recently, do you think that our continual drive as a country to be better and be more innovative, is that pushing the markets? What's happening here?
Do you think the internet changed everything?
Darn tootin'.
35 years ago, I was writing a weekly column and I faxed it in.
Do they even make faxes anymore?
I know nobody has a fax anymore. It's hysterical. Who has a fax? Just before, earlier today, I was listening to something on the news or something like that, a local, and they are now going to use artificial intelligence to read colonoscopies. They're working on the gradients and the scales to help spot anomalies and help physicians and radiologists spot anomalies. Do you think the way the internet changed the world? It's hard to think back before, but we're old enough to remember.
Sure.
I mean, I remember when remote controls happened on TV. That's how old I am, and I think that changed the world at the time. I got one of the first car phones ever because I don't know.
I had one of those that was huge.
It was big. It was big, yeah.
By the way, remote control, for all the people, this will make them laugh. My dad had a remote control, and you're like, really? Yeah, it was me. He'd tell me go turn the channel.
Exactly.
So I was always getting up and down. Turn to channel 6.
There were only 3 or 4 channels. So we were just proving we're old. What I'm trying to say is that you've been through cassettes and 8-tracks, and it's on your phone.
Blu-ray disc. I've got a really good deal on some Blu-ray discs for you, Terry.
Yeah, exactly. You might at an antiques fair get something for those. Look, that's what's exciting. That's what's exciting about a free enterprise economy. That's what's exciting about America. The fact that great minds get a chance to develop new things that'll help medicine and help consumers and just change our lives. And that's why you always have to be open. You always have to be investing.
Mhm.
That's what the stock market, a diversified portfolio, gives you, not the hot stock
Mhm.
of who's going to find. But they were finding cures for medical issues. I think the cancer moonshot is, whether it becomes under Biden's presidency or down the road. We look back and think 100 years ago they were still putting leeches on people to cure them. I think there are just so many wonderful things that are coming down the road that will be investments for all of us.
Mhm.
And what our job is to keep the free markets alive
Mhm.
and rewarded within boundaries of full disclosure and equity. So I'm just a real cheerleader for America, and I think we're
Yeah.
beginning to understand the opportunities ahead of us. So when you ask about AI, I'd love to be around to see all the things it does. I'm not afraid
No
of
doubt.
robots, coming in and.
No. Well, in the political tribal environments that we're in, I want to remind people that this is a great country and it is unmatched. And I was talking to someone this morning. I said, if there was and he mentioned his tribal policy, the tribal group he was a part of. I said, okay, so you're red or blue. If the opposite person was standing beside you and you totally disagreed with them politically, and you're standing on the street corner and they got attacked randomly, would you stand up for them and fight for them? He said, absolutely. I said, exactly. We got to get back to that as a country. 9/11 showed that we all are in this, we're all in together. Okay. And I'm hoping that we can go toward that. And I know you guys are out there saying, Stan, you're getting sappy and you're going to cry. And no, I'm not. I'm just saying we forget the opportunities that this country provides. Someone like myself, someone like you that knocked the door down and then took a hammer and beat the glass ceiling into pieces to get on the Chicago Board of Options. That's insane, but that's fantastic in a country like this. I really wish that, and I know I'm hoping that politicians would talk like that more instead of getting personal and putting each other down. I don't know how we got to that and the consultants that tell them that work, but it doesn't work on me. I'm looking for people's ideas, whether it's in the private sector, the public sector. I don't really care. I just want to hear ideas. I want to hear people thinking. I want IQ when I'm turning on the television, which is now hard to find. I want IQ. That's the reason I think that entrepreneurs and people that are involved in technology, they've tuned all that out. They're going forward with their ideas, hopes, and dreams. And that's the reason I think you see the stock market where it's at, my opinion.
Well, you know what? I happen to agree with you perfectly. Maybe that's the right place to end it, but let me say a couple of things. You made a very good point about that. No matter what, you're still going to have to manage your own money and your own future, your own income in retirement. That's the goal, to have enough to generate income and then leave some to your family. So I happen to think this is a perfect time to do some financial planning of your own with someone sophisticated and someone you can trust.
Mm-hmm.
And let me just say this. I sell nothing. I have no clients. I've never gotten a penny from endorsing a product or service. My brand is Terry Savage, The Savage Truth on Money. That's the title of my most recent book, which the 4th edition of is now a couple of years old. And my goal is to introduce people to places where they can get trusted financial advice. I'm going to come to you last, but let me give you some of those places. I think the most important thing in evaluating a financial planner is that it be a fiduciary, and a fiduciary who fully discloses all costs, and preferably a fee-only fiduciary.
Not fee-based.
Pardon?
Not fee-based.
Not fee-based. Fee
only.
only. They're not competing for a trip to
Bora Bora,
Hawaii or whatever else it is,
exactly.
based on the number of units they sell of this,
Exactly.
that, or the other thing. They're not getting a trailing commission. So my good friend now, and my co-podcaster, and you've been on our Friends Talk Money podcast,
Yeah.
Pam Kruger, created
Yeah.
something called Wealth Ramp, wealthramp.com, which is like Match.com for fee-only fiduciary advisors. There's number one. Number two, Larry Kotlikoff, you're going to have him back. I've just posted a new article.
Yeah, I need to talk.
He called out Fidelity, and you can find it on his Substack blog, Kotlikoff, Larry Kotlikoff. He called out Fidelity's financial planning in his most recent blog that I want to send a copy of that and the column I've just posted on terrysavage.com about his Maxify planner, MAXIFI planner.com, which is economics-based financial planning. You need to have him on to talk about that.
Absolutely.
It's something you can do yourself very inexpensively. They will help you through it. They do it. They have financial planners that license this software, but he just called out Fidelity and Vanguard and every other big for giving misleading planning advice that's not based on economics. This is going to be the next big blow up here. So
I agree with that. I think the financial industry is going to change. Definitely.
I think, and then I do believe, first of all, I have annuity money that drops into my checking account on a regular basis. And can you see me smile when I say it? Because it always comes as a surprise, a delightful surprise. And in fact, I didn't really I bought these annuities back when, because I was trying to understand them well enough to write about, and I didn't want to write about something that I wouldn't do myself. And here I am all these years later, and the money's coming. So I believe in annuities in their place in your portfolio.
For some, not all.
Pardon?
For some people, not all.
No, in their place in your portfolio.
Sure.
And I cannot tell you, Stan, will tell this is true, because on my Ask Terry blog, I get these questions. I got talked into this thing. I don't know what it is. And I go, you know what? I can't diagnose this, but go to stantheannuityman.com, set up an appointment, and you can trust the advice he gives you. So when I talk about getting trusted advice, I get nothing out of that, nothing out of these recommendations. But there's so much misleading information out there.
It's terrible. From
some very well-known names. That's how they get all the money to run the ads and the commercials and build the big buildings. So my brand is The Savage Truth. And I welcome you at terrysavage.com. Post your questions. If you write about an annuity, the odds are, if I don't know the answer right off the bat,
that's right,
I will copy it and send it to Stan and say, help me answer this reader.
Well, we're the only site. And, you know, we're licensed in all 50 states. We're the only site that has a place where you can click it for second opinions. Is if you've either bought something or been pitched something and you just want a second opinion on it, we'll give it to you. We're not going to try to sell you something. We're going to give you either what the facts about what you own. That's been a game changer because people they just want to know. I tell people all the time, if you can't explain it to a 9-year-old, don't buy it. No offense to 9-year-olds. You know, Warren Buffett, who you know and have videos on your site with, yes, Terry and Warren Buffett. I mean, if he doesn't understand it, he doesn't buy it. I don't know why people want to make it so difficult. Understand what you're doing. Take your time. There's no urgency to buy or make a move. If someone's trying to make you sign the paper, you're going to miss out on this and that, then walk away, period. Been doing this for 30 years. Terry's been doing this for 40 plus. Listen, there's no urgency. The only urgency is for you to understand what you're doing.
Exactly. And get good advice before you do it. Believe me, you don't want to be funding their retirement. You want to be funding yours. That's the savage truth.
Terry Savage, it's so great to catch up with you. You know, we haven't seen each other like face to face and dinner for years. That has to change one of these days. Our Learjets have to meet on the tarmac, right?
No. I might head out to
here.
You don't come to Florida. Okay.
Well, listen, take care. Thank you so much. And thanks everybody for joining Fun with Annuities. See you next time.